Preparing for FP&A Analyst at Orange interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A mean to you, and how would you add value at Orange? FP&A connects operating performance, financial forecasts, and management decisions. In an Orange role, I would translate subscriber trends, pricing, churn, network investment, and energy costs into revenue, EBITDA, cash flow, and capital allocation views. I would compare actuals with budget, explain variances, and update outlook assumptions. The value is not merely producing reports. It is giving leaders an early, credible view of performance and the actions required to protect profitability. While answering, focus on linking financial analysis to operational decisions, understanding Orange's telecom drivers, communicating insights clearly, and showing that FP&A goes beyond reporting to influence performance and resource allocation. Question 2. Walk me through how you would build an annual budget for Orange. I would begin by understanding Orange's strategic targets and planning timetable, then build a driver-based budget with commercial, network, technology, personnel, and corporate teams. Revenue would reflect customers, usage, pricing, churn, and product mix. Costs would incorporate volumes, contracts, inflation, and investments. I would challenge assumptions against historical trends and market data, reconcile bottom-up submissions with leadership targets, model sensitivities, and document ownership. Finally, I would secure sign-off and establish monthly tracking against the approved plan. Make sure to cover the planning calendar, bottom-up operating assumptions, top-down targets, revenue and cost drivers, stakeholder alignment, scenario analysis, review cycles, and final approval and ownership of the budget. Question 3. How would you forecast revenue for a telecom business like Orange? I would forecast revenue by product and customer segment rather than applying one growth rate. For mobile, I would model opening customers, gross additions, churn, net additions, usage, and average revenue per user. Fixed broadband would include homes passed, penetration, installations, and pricing. I would separately assess enterprise, wholesale, and equipment revenue, incorporating seasonality and promotions. Then I would compare the build with market trends, commercial guidance, and prior forecasts, investigating any material reconciliation differences. In your answer, talk about customer volumes, average revenue per user, churn, acquisitions, usage, pricing, product mix, fixed and mobile services, seasonality, and reconciliation to reported results. Question 4. Which KPIs would you monitor when assessing Orange's performance? I would monitor revenue growth, EBITDA margin, operating cash flow, capital intensity, and free cash flow alongside customer metrics. Important commercial indicators include mobile and broadband subscribers, gross additions, churn, ARPU, convergence, upselling, and customer acquisition cost. I would also track network quality, data usage, energy consumption, and service complaints because operational trends often precede financial outcomes. The key is connecting KPIs. For example, lower churn may support revenue growth but require higher retention spending. Be sure to mention financial and operational indicators, including revenue growth, EBITDA, cash flow, subscribers, churn, ARPU, customer acquisition, network metrics, capital intensity, and KPI interdependencies. Question 5. How do you analyze actual results against budget? I start with a bridge from budget to actual, separating volume, price, mix, timing, foreign exchange, and exceptional items. For example, a revenue shortfall might reflect fewer broadband additions, while an EBITDA variance could stem from energy prices or delayed hiring. I quantify each driver, validate the explanation with commercial and operational owners, and distinguish recurring issues from one-offs. I then update the forecast and recommend actions, rather than simply describing the variance after month-end. Focus on separating volume, price, mix, timing, foreign exchange, and one-off effects, quantifying drivers, validating with stakeholders, distinguishing controllable from uncontrollable items, and translating findings into corrective actions. Question 6. What is the difference between a budget, forecast, and long-range plan? A budget is the approved financial commitment for a defined period, usually with detailed targets and accountability. A forecast is the latest estimate of what will actually happen, so it should change when performance or assumptions change. A long-range plan extends several years and connects financial outcomes with strategic choices such as network investment, technology evolution, and market positioning. At Orange, I would use the budget for control, the forecast for decisions, and the long-range plan for direction. Make sure to distinguish their purpose, timing, level of detail, flexibility, and connection to strategy, while explaining how each document supports different management decisions at Orange. Question 7. How would you investigate an unexpected decline in EBITDA margin? I would first confirm the margin calculation and compare the decline across countries, products, and months. Then I would build revenue and cost bridges, testing pricing, churn, mix, promotions, roaming, energy, personnel, supplier costs, and one-off charges. I would speak with commercial, network, and procurement owners to validate operational explanations. Finally, I would classify the pressure as temporary or structural, quantify its forecast impact, and propose actions such as repricing, cost control, or investment timing changes. In your answer, cover revenue mix, pricing, churn, direct costs, personnel, energy, roaming, promotions, one-offs, operational owners, variance bridges, and the distinction between temporary and structural margin pressure. Question 8. Tell me about a time you identified a significant variance or error in financial reporting. In a previous reporting cycle, I noticed operating costs were materially above trend despite stable activity. I traced the variance to a recurring supplier invoice loaded into the wrong cost center and duplicated in the accrual file. I reconciled the ledger to supporting schedules, quantified the impact, alerted the controller, and coordinated the correction before management reporting. I then added a duplicate invoice check and clearer ownership rules, reducing the risk of recurrence in later closes. Be sure to structure the example using situation, analysis, action, and result. Emphasize control discipline, root cause investigation, stakeholder communication, quantified impact, and preventive improvements. Question 9. How would you evaluate a proposed network investment at Orange? I would assess the investment through both strategic and financial lenses. The model would include CapEx, maintenance costs, energy, incremental subscribers, ARPU, avoided congestion, enterprise opportunities, and working capital effects. I would calculate NPV, IRR, payback, and cash flow timing, then test sensitivities for adoption, pricing, delays, and cost overruns. I would also consider coverage obligations, network resilience, and customer experience. Approval should include measurable benefits and a post-investment review comparing actual outcomes with the business case. Focus on strategic rationale, customer and traffic benefits, CapEx and OpEx, NPV, IRR, payback, capacity, risk, regulatory factors, sensitivities, and post-investment performance monitoring. Question 10. How would you build a scenario analysis for Orange's outlook? I would establish a base case using the most supported assumptions, then create upside and downside cases around the variables with the greatest financial sensitivity. For Orange, these could include churn, ARPU, broadband additions, energy costs, wage inflation, foreign exchange, CapEx timing, and competitive intensity. Each case would show revenue, EBITDA, cash flow, and leverage implications. I would define trigger indicators and management actions, so scenarios become decision tools rather than static alternative spreadsheets. Talk about base, upside, and downside cases, explicit assumptions, sensitivity to churn, ARPU, subscriber growth, energy, CapEx, rates, and foreign exchange, probability, triggers, and management actions. Question 11. How would you explain financial results to a non-finance executive? I would lead with the conclusion, not the spreadsheet. For example, I might say EBITDA was below plan primarily because weaker mobile additions and higher energy costs outweighed savings in personnel. I would use a simple bridge, quantify the impact, explain whether it is temporary, and identify the decision required. I would avoid unnecessary accounting terminology and confirm understanding through discussion. The objective is to help the executive act quickly while preserving enough detail for challenge and follow-up. Make sure to cover audience adaptation, concise messaging, visual storytelling, business drivers, materiality, implications, recommended actions, and avoiding technical accounting language unless genuinely necessary. Question 12. What would you do if a business partner challenged your forecast assumptions? I would first understand why the business partner holds a different view and identify which assumption creates the gap. I would compare historical performance, current pipeline data, market evidence, and operational capacity, then make the model logic transparent. If uncertainty remained, I would show the financial impact of both views and agree on observable indicators or a range. I would escalate only when necessary, framing the issue as a decision about risk rather than a personal disagreement. In your answer, emphasize curiosity, evidence-based challenge, transparent assumptions, sensitivity analysis, listening to operational expertise, escalation when needed, and maintaining a constructive relationship. Question 13. How would you improve a slow or error-prone monthly reporting process? I would map the process from source data through final commentary, identifying manual rekeying, duplicate reconciliations, unclear ownership, and late inputs. I would standardize templates, automate repeatable data pulls where possible, and add validation checks for totals, periods, and unusual movements. I would create a timetable with accountable owners and documented procedures. After implementation, I would measure close time, error rates, and rework. Automation should strengthen control and insight, not simply move errors faster. Focus on mapping the process, removing manual steps, standardizing templates, automating data collection, validating inputs, documenting controls, setting deadlines, and measuring improvements in speed and accuracy. Question 14. Which Excel or data analysis tools do you use for FP&A work? I use Excel for driver-based models, variance bridges, scenario analysis, pivot tables, XLOOKUP, SUMIFs, and structured checks. I use Power Query or similar tools to clean and combine recurring data, reducing manual manipulation. For management reporting, I am comfortable building clear dashboards in Power BI or an equivalent platform. I also understand ERP extracts and data definitions. I focus on traceability, separating inputs, calculations, and outputs, so another analyst can review and reproduce the result. Be sure to mention practical Excel capabilities, data integrity, modeling structure, Power Query or equivalent tools, visualization, ERP familiarity, and how tools support analysis rather than replace judgment. Question 15. How would you assess the profitability of a customer segment or product at Orange? I would begin with revenue by segment, including recurring service revenue, equipment, and relevant wholesale items. Then I would calculate contribution margin using direct network, content, acquisition, care, and retention costs, while treating allocated overhead carefully. I would analyze ARPU, usage, churn, customer acquisition cost, lifetime value, and product mix. A segment may have modest current margin but strong strategic value, so I would present both standalone economics and broader benefits before recommending pricing or investment changes. Discuss revenue quality, direct and allocated costs, customer lifetime value, churn, usage, acquisition and retention costs, contribution margin, allocation limitations, and strategic value. Question 16. How do interest rates and foreign exchange affect Orange's financial planning? Higher interest rates can increase borrowing costs, reduce free cash flow, and affect refinancing decisions or investment hurdle rates. Foreign exchange can change reported revenue, EBITDA, debt balances, and the cost of equipment purchased in another currency. I would separate translation effects from transactional exposure, identify which items are hedged, and use current market assumptions consistently. I would then show sensitivities for rates and currencies, helping management distinguish accounting volatility from genuine operational performance. In your answer, cover debt costs, refinancing, cash flow, valuation, currency translation, transaction exposure, local operations, hedging assumptions, and scenario impacts on guidance and capital allocation. Question 17. How would you incorporate cost-saving initiatives into an Orange forecast? I would create an initiative register showing the baseline, owner, timing, category, one-time cost, recurring benefit, and confidence level. Savings would enter the forecast only when supported by a specific action, such as contract renegotiation, process redesign, or workforce efficiency. I would avoid double-counting overlapping initiatives and distinguish gross savings from implementation costs. Monthly tracking would compare realized benefits with the plan, explain slippage, and update the outlook when execution risk changes. Focus on initiative scope, baseline costs, timing, ownership, one-time implementation expenses, run rate benefits, execution risk, double counting, and tracking realized savings against the approved business case. Question 18. How would you balance cost control with customer experience and network quality? I would not treat every cost as equally reducible. I would assess each proposal against service quality, churn, complaints, network reliability, regulatory requirements, and long-term revenue. For example, postponing low-priority administrative spending may be sensible, while cutting maintenance could create outages and higher future costs. I would model immediate savings alongside potential customer and financial consequences, then prioritize efficiency that protects the customer proposition. Sustainable cost control should improve productivity without damaging network trust. Make sure to discuss value-based prioritization, service quality metrics, customer churn, regulatory obligations, short-term versus long-term effects, scenario testing, and avoiding indiscriminate reductions. Question 19. What would you do if Orange missed its forecast for several consecutive months? I would investigate whether the issue reflects biased assumptions, poor data, delayed timing, or genuine operational deterioration. I would compare forecast accuracy by driver, segment, and owner, then revisit leading indicators such as churn, additions, ARPU, traffic, and project delivery. I would discuss the evidence openly with stakeholders and reset the forecast rather than protect an outdated target. I would also introduce forecast ranges or confidence levels where uncertainty is material, improving credibility and decision quality. Talk about identifying forecast bias, revisiting drivers, separating operational underperformance from assumption error, engaging stakeholders, resetting transparently, improving leading indicators, and preserving credibility with management. Question 20. Why do you want to join Orange as an FP&A analyst? Orange appeals to me because Telecom combines recurring revenue, rapid technology change, substantial network investment, and direct customer impact. That creates a rich FP&A environment where analysis must connect commercial behavior with operational execution and cash generation. I would bring structured modeling, careful variance analysis, and clear communication, while learning from a complex international business. I am especially motivated by helping leaders evaluate growth, efficiency, and digital investment decisions with disciplined, forward-looking financial insight. Be sure to connect Orange's telecom scale, digital transformation, network investment, sustainability agenda, international complexity, and customer impact with your analytical strengths, learning goals, and motivation for FP&A. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.